Great to have you. Happy Friday to you.
Same to you. Good to be on.
We've had a long discussion this morning about how it's maybe net dovish for the Fed. Would you go along with that?
I think it is. If you look at payroll numbers, in line but revised down, household survey somewhat softer, at least in terms of unemployment rate and broader measures of underemployment, and then somewhat softer earnings. So I think this is consistent with stepping down at the next meeting from 75 basis points to 50 basis points. We still get a CPI that's going to be very important, but I think if that is on the somewhat softer side as well, I think they could step down.
On CPI, we've also talked about how the market's conditioned now to goods disinflation, certainly lower energy prices. So is there much to be how weak would CPI have to be to move your Fed forecast even further?
I don't think it would move it even further. I think I would be very surprised if they did less than 50. But the debate has been between 75 and 50. And I think what we've learned in the last CPI and in this jobs report argues for 50.
What are the data points that you think that the Fed is looking at here with regard to that decision making? I know some Fed officials have said they're just not even really paying much attention to this report at all. And it's all about more of the inflation specific data. But as you look at things like average hourly earnings, lighter than expected, average hours coming down. So clearly some lower wage pressure here. That has to stand for something, right?
Yeah, I think both the CPI and the jobs numbers are the top tier reports that have the biggest impact on decision making. And payrolls historically have been the most important. The employment report has been the most important. Now I would say they get approximately equal billing. And I'd agree with the assessment that most of what we saw today was on the somewhat softer side.
Me, I guess, is what everybody's looking at. I do wonder, and I asked this question to Brian Deese as well, is the Fed working against sort of the idea of a more robust recovery in the job market in a way?
Well, I think they think that the labor market is overheated. If you look at the gap between job openings and unemployed workers, that's a more than 5 million gap. And so they know that job growth, labor demand has to come down. Ideally, it comes down through declines in job openings rather than, declines
11 million of which we currently have the latest read.
That number needs to come down. It has been coming down somewhat, although the last data point was higher, so that was a more hawkish piece of information. Although if I look at the last several weeks as a whole, with the weaker CPI and the slightly softer jobs report, I think on net it's a bit dovish. But
how do you think the Fed is viewing these various endpoints? I mean, obviously the jobs number is an important one. Is it equal to or in excess of what they may be looking at in terms of the latest inflation data?
Well, I think it's in addition because the latest news has been a bit softer on both. So, it doesn't, in this particular case, it doesn't matter as much how you weight these things because they've been pointing in the same direction. We could be in a different position again after the next CPI for all we know. But I think at the moment, the way the signals are coming in is that we're more in the sort of soft landing environment.
Well, were you surprised then by what you heard last Friday from the chairman?
Well, I think he's saying that they still need to. Inflation is still way too high. There, maybe some early signs of adjustment, but 1 month's number doesn't, shift their view. So it is going to be important what we see, in the August CPI report and in the next couple of months. They don't shift their view as quickly as perhaps market participants do on one number.